We've seen a lot of discussion about the record level of profit margins, especially if you look at the aggregate level of net after-tax profits of U.S. corporations. We're at record levels, and in fact, on an after-tax basis, it's unprecedented. However, if you look pre-tax, it's still at record levels, but it's not unprecedented. We saw these levels in the 40s and 50s. And part of the issue with what we're seeing now is the lower effective tax rate. And to a large degree, large U.S. corporations are going to dominate the aggregate profit level. U.S. corporations have offshored a lot of their business, moving manufacturing to Asia, which has gotten the benefit of lower tax rates. So many are concerned, of course, that since we're at record levels, that there's this reversion to the mean that must happen, and therefore after-tax corporate profits must come down. But it's important, I think, to look, beyond that, not just at the aggregate levels, but by cap size, because there's a big difference between corporate profits by cap size. So we take the value line index and separate it into deciles, and then look at the net after-tax profit relative to sales and go back over the last 20 years. And when we do that, some interesting things come out. First, the top decile, the biggest companies, are in fact at record levels, and it mimics what you see on an aggregate corporate profit level. But once you start going down cap size, and once you get to the 9th and 10th decile, so the small cap stocks, they're actually not even at record levels. They're at the bottom end of their levels. So from the early 90s through 2000, if you take the average of the entire period, the smaller cap size are at the lower end of their profit levels. But in addition to that, the valuations are low too. So while you have margins at the high side in the big cap stocks, and what most consider to be moderate level of multiples, I think most people are concerned about the reversion to the mean. But looking at the smaller deciles, you've got stocks that are selling cheap based on an asset base. So we look at price to tangible book. And when we dig through the small cap stocks, we find them very close to their lowest levels that they've been at over the last 20 years, and their profit is at the low end of their profit cycle. So when we look to the first quarter, a lot of these smaller companies are now starting to hit their profit strides, so their profits and sales are now rising. And I think that's a reflection of the domestic economy being a bit stronger than some of the international stocks. So a lot of these international companies, the multinationals, have suffered some earnings disappointment. Not that they've necessarily, their earnings have declined, but the rate of growth is declining, and some have declined. On the small side, however, we're starting to see the benefit of, I think, what a separation, if you will, from an economic standpoint, with the domestic economy being slightly better, and that's starting to flow through into the small cap stocks.
And as you know, Jim, even within our space of small cap stocks, the smallest of them, what we call micro cap stocks, did nowhere near as well as the larger small cap stocks.
Well, those small cap stocks continue to be ignored, but eventually their time will come, and when they do, it'll be powerful.
It will be, and we hope soon.
Yes.